You see the tailored suit. You see the luxury sports car. The man on your screen appears to be a successful trader. In reality, his followers finance that lifestyle. By 2026, the influencer portfolio has mutated. What began as a trend of sharing stock tips on social media has become a quantifiable systemic risk for retail investors. The scale of the problem is staggering. As of February, the Securities and Exchange Board of India has flagged over 1.33 lakh misleading social media posts tied directly to securities manipulation. Regulators refer to this as an expectation mismatch. Viewers watch a reel believing they are getting exclusive access to a hidden gem of a stock, while they are actually entering a coordinated trap. Following a blue checkmark stock tip amounts to volunteering as the victim of a financial exploit. To understand how this works, we have to map the viral social media pitch against the actual, invisible timeline of market data. This chart shows the precise anatomy of exit liquidity. On this flat, low-volume trendline for a microcap stock, the creator makes a massive, quiet purchase long before the camera ever starts rolling. Then comes the hype phase. The influencer posts their video, leveraging audience trust to drive millions of followers to buy the stock simultaneously. The artificial demand spikes the price. At the absolute peak of that retail buying frenzy, the creator sells all of their initial shares. The price crashes instantly, leaving the followers trapped at the bottom. Mathematically speaking, every single rupee of the influencer's profit is pulled directly from the capital their followers lost. This dual bar chart compares two different approaches. On the left, the broad market Nifty 50 delivers a steady annualized return of 16 to 17%. On the right, these hype stocks carry a volatility 3 times higher than the market index. The data reveals the brutal reality for the retail buyer. Within 6 months of that initial social media shout-out, the average influencer stock loses 45% of its value. Investors ignore these red flags because of the parasocial trap. Watching a creator's daily life on screen creates a false sense of friendship, leading viewers to trust financial advice because they feel a personal connection. That trust obscures how these creators actually make money. Research shows that brand deals, lucrative affiliate fees, and pump and dump cycles generate 86% of their wealth. The luxury lifestyle so casually flaunted on screen is nothing more than a marketing prop, paid for entirely by audience exploitation. Regulators have attempted to close this gap. Under the 2026 IT and SEBI rules, anyone giving financial advice online must display a verified registration number or risk having their content blocked within 3 hours. Influencers evade these rules by burying a microscopic educational purposes only disclaimer deep in their profile bios, while continuing to push high-risk celebrity stock picks. Building a portfolio based on reels forces you into a high concentration strategy. You are left with hidden commission fees and a total lack of fundamental research. The only true defense is abandoning the hype. Protecting your wealth requires evaluating assets based strictly on their intrinsic value. Analyzing actual cash flow acts as a shield. When you focus on the real numbers a business generates, you become immune to algorithm-driven market traps and social media manipulation. True wealth protection in 2026 requires severing the parasocial connection. Before you invest a single rupee, demand verified regulatory proof. Don't be the exit liquidity for someone else's vacation.
Let's discuss that in the comments section. And as always, thanks for watching Alux Live. Subscribe for more.